Hello and welcome to this Commerzbank webcast. Secular stagnation is a concept that sounds logical to many on the financial markets. After all, the major economies have been very slow to recover from the financial crisis. But more important than the label are the causes of this weak economic performance. The supporters of the theory of secular stagnation believe that investment demand is lagging well behind savings due to long-lasting factors such as the advance of services. Consequently, aggregate demand has been too low structurally. The only thing that helps is loose monetary and fiscal policy. However, there are better explanations of the weak economic performance than a structural lack of demand. Firstly, in the US, growth of the working-age population has weakened markedly in the past 10 years. This explains about half of why the US economy has picked up little since the end of the financial crisis. For other developed nations, demography plays an even greater role. Secondly, the weak upswing can be explained by the emergence and bursting of the global debt bubble. Many US homeowners with high debt had to repay this debt and hold back with consumption, which has depressed US economic growth. And the supply side of an economy is also suffering from the after effects of a burst of a debt bubble. Many banks are keeping heavily indebted companies afloat with new credit to avoid having to write off many bad loans. This is taking resources away from healthy and productive firms. And this is pushing down productivity growth. The Eurozone is particularly affected. To avoid these problems, politicians and central bankers should do everything they can to push forward the balance sheet repair of consumers, businesses and banks. However, the Eurozone is making very little progress here. The problems of the monetary union risk becoming chronic. The ECB will remain under pressure for some years to gloss over the unresolved problems of the monetary union through loose monetary policy. For more details, enjoy reading our Week in Focus, please.